Yes, I'm from the Institute of New Economic Thinking at the other place, so you'll have to forgive an intrusion to English domination. It's a great pleasure to be here. Thank you to the organisers for inviting me to chair the session. I've known Rob almost entirely for his academic career from 1970 onwards. And
Here,
that
in
actually was
Cambridge.
actually in Cambridge, indeed, at the Econometric Society World Meeting of that year. And a great admirer of his immense creativity and innovation, his high technical ability, his tremendous empirical skills. And I have to say, he's not a bad co-author either. So, one of my other co-authors told me that when introducing people who don't need an introduction, you should say three things. You should be witty, you should be brief, and you should be gone.
Well, thank you all. It's a great pleasure to be here. I've certainly enjoyed the time at this conference, and it's so interesting to talk about these important issues of our times, because really the financial sector remains a topic of heavy discussion and a lot of divergent opinions as to what really we should be thinking about. And so it's good to have a long-term setting where we can discuss these issues. So what I'm going to talk about today is, well, it goes by this pretentious title, Prospects for Global Financial Stability, and I'm going to show you a little bit how we think about that, and then a little more on what are some of the new directions and the approaches to validation of this kind of model. So, in many ways, the whole systemic risk literature was at least invigorated, if not born, on September 15th, 2008, when Lehman declared bankruptcy and the most severe events of the financial crisis began. But we tend to forget that that was also when the U.S. had rescued or nationalized Fannie Mae and Freddie Mac the week before, and then had to save AIG on Tuesday. Merrill Lynch was rescued over the weekend. Citigroup needed bailing out. Bank of America, Morgan Stanley, Goldman Sachs, Washington Mutual, and Wachovia both failed. And so it was a pretty amazing month. I mean, you know, when we talk about economic history, you know, the mind boggles at trying to remember what it felt like with all those things going on. We continually raise the question of whether we should have rescued Lehman and stopped all this from happening. But of course, as soon as we answer the question whether we should have rescued Lehman, then there would be the question, should we have rescued Washington Mutual? And, well, I mean, nobody thinks we should have done that. So, I mean, where is sort of a question we're thinking about. So, of course, we know very well that if we had advertised that we were going to rescue firms in trouble, there would be the moral hazard issue and they would take on too much risk. And Dodd-Frank reinforced this by saying firms have to file living wills, and future bailouts will be prohibited in some way. Well, that actually is not going to prevent bailouts, I don't believe. But anyway, so we're still faced with this question. And what I'd like to say is that there is a third choice. It's not whether or not to bail out these firms. And the third choice is don't get in the situation in the first place. And it's easy to say that, obviously, but really that's what the whole regulation bit is about. You know, can regulation keep us from getting to the point where we have to decide whether or not to bail out this firm? And so that's kind of why we're all doing this. It's not, we're not wanting to study ex post whether we should have done one thing or another. We're asking, how should we move forward? what are the regulatory challenges that face us? How can we regulate this financial sector without emasculating it, without keeping it from doing its important functions? And how can we do this in a timely basis? And so that's kind of what we're talking about. So when we talk about systemic risk, we're talking about how the failure of an institution to meet its obligations has an impact on the real economy. We don't want to forget this real economy part of the systemic risk issue. That's the reason we're interested in this. That's the reason, even though we'd like to let firms fail, we may not end up doing that. But I think we also want to take into account the fact that the failure of one firm will be much more damaging to the real economy if the whole financial sector is weak. We've seen lots of examples of banks that fail and don't produce what we saw. Why not? Well, because there were competitors willing to step in and take over the business. And that's actually an advantage for the competitors. In September of 2008, there was nobody that was ready to step in and buy the assets of Lehman, apparently, and let alone take over the business that they were doing. Everybody was fighting for their existence. So the regulatory challenge is to ensure that financial institutions have sufficient capital so that they can not only survive a financial crisis, but can continue to intermediate and provide financial services to the real economy. So the theme of this is good regulation is prevention, not rescue. But, you know, can we do this? I mean, that, you know, it's from a scientific point of view, how will we ever know? If we prevent future financial crises, then we didn't know whether they would have happened if we didn't prevent them. We don't. Anyway, it's obviously there's a scientific question here which is really hard to answer. So I'm going to show you some estimates that are the answer to this question. How much capital would a financial institution need to raise in order to function normally if we have another financial crisis? So this is a question that sounds simple, maybe it doesn't sound simple, but in any case, we're going to try to estimate the answer to that question based on public market data from US equities, global equities, balance sheet data, and the answer that I'm going to give you is published on VLab on the website, and I'll show you pictures from this website, but it's something you can all look at your leisure, but it changes. It's updated every week, and so I showed you some pictures yesterday from March. The pictures today are a little different, and that's one of the things that's interesting about it. Now, I should say that what I'm going to show you today is mostly work that was started and done in large measure with Christian Brownlees, and the website is really his architecture and creation, although we've got many people involved now that are pushing it forward. But anyway, you can go talk with him about it too, actually. So what we're going to calculate is this measure S-risk, which has been mentioned several times. And what it's supposed to be is the expected capital shortfall of a firm conditional on there being a crisis. That's what we want to estimate. And what we mean by a capital shortfall is that the equity capital of a firm is inadequate. So in other words, we think that there should be some capital ratio, some ratio of assets to equity that should be maintained even in a crisis. And so that says there's some parameter K, which multiplied by the future debt plus equity should be less than the equity in this state of nature. And if it's not, there's going to be capital needed, and that's what we want to measure. We want to measure how much capital will be needed. Now, for the debt, we're going to take accounting data on the liabilities. So it's really the book value of the liabilities, which is what could come due in this future period. But it doesn't actually change very much over time, partly because accounting data doesn't change very fast, but also because it's a stock, and so it's hard. You don't adjust the stock very fast. What really changes in a crisis is the value of the equity goes down. And that's what we're going to try to estimate. How much does the equity base collapse for a financial firm? And that turns out to be the econometric issue, where we are trying to estimate what we call the long-run marginal expected shortfall. That is conditional on a crisis. What do we think the expected decline in the equity market cap of this firm is going to be? So we're going to take a value of K that comes out of a lot of the studies in central banks. We're going to use 8%. That actually is a number that Philip Hartman, I think, would not take issue with, although he's probably measuring it relative to risk-weighted assets, and we're thinking of it relative to total assets, so that's different. We've made an adjustment for IFRS firms because their balance sheets are actually bigger, so we use a lower capital ratio, 5.5%. The point is, it doesn't exactly matter what these numbers are, because we're going to look at both across firms and across time holding K fixed. So we're seeing changes in the capital adequacy as over time. So from this formula, it's clear that S risk depends on the size of the firm. If you double all these things, debt and equity, you're going to double the S risk. It depends on the leverage of the firm. The debt-equity ratio is a key determinant of this, and it depends on the risk, which is where the long-run MES comes in. If the firm is volatile and has high risk, which is highly correlated with the behavior of the broad market, which is what we think goes down in a crisis, then the long-run MES will be a big number. Okay, so just quickly, here's an example from Bank of America. It has a market cap of about $160 billion. Its accounting liabilities are about $1.9 trillion, so it has a leverage ratio of around 12. This is actually not current information, but give you the idea. So if we have another financial crisis, which we are going to consider to be a 40% drop in the broad, actually global equity market over the next 6 months, which is about what happened during the financial crisis, then we estimate the shares in Bank of America will fall by about 50%. So if the market goes down 40%, Bank of America we think is going to go down a little more. It's got a beta bigger than 1, so that's kind of where that comes from. And that is going to reduce its market cap. It's going to increase its leverage, and the amount of capital it's going to need in order to bring its leverage back to capital ratio back to 8% is $77 billion. Okay? Now, Crédit Agricole is another example. This is my bank in Europe and in France, so I can talk a little bit about it. But Crédit Agricole has a market cap of $30 billion and has liabilities of about $2.3 trillion. It has a leverage ratio at this time of 78. Well, that is very high. Crédit Agricole is in trouble. Now, some of you who know the corporate structure of Crédit Agricole will say, yes, but they're the regional Crédit Agricoles and they own the bank and the bank owns them and there's this cross-holding. We've done a lot of calculation of that, and actually that doesn't really change this particularly. It turns out the capital shortfall of $112 billion to bring the leverage down now is very little affected by the risk of this bank. In other words, this bank is undercapitalized today. In a stress scenario, it will be undercapitalized a little bit more, but the bulk of what we're talking about has nothing to do with the model of risk we're talking about. It has to do with the fact that the bank is undercapitalized today. So how do we get these betas, or the long-run MES that we're talking about? We use something which I like to call dynamic conditional beta, and essentially it's the beta that we use in finance all the time, except that it's not constant. It's always changing. It changes over time, and it's really a correlation times the ratio of two volatilities. And what we have to do is estimate, using the most timely data we have available, the correlation between the global equity market and this company's stock, and then the volatility of each of the company's stock. We use a global ETF to define what we mean by the aggregate market. We adjust for asynchronicity between the firms and the timing of the global ETF, because many of them are international firms traded at different time zones. We use the asymmetric volatility model, the GJR model, to estimate the volatility, and DCC models to estimate the correlations, and we do it on post it on VLab. Now, what actually I'm going to show you are the estimates from what I call the nested model. So if we were estimating a constant beta model, what we would do is we'd regress the returns from this bank on the market returns from this global ETF, and we would also put in the lag of the market return. And the reason we put in the lag is because some of the returns of a foreign bank occurred when yesterday's market was open in New York. So especially for Asia, the bulk of the effect is on the lagged return, and for Europe, the bulk of the effect is on the current return, but we put them both in here. So these would be the coefficients I call phi 2 and phi 4. But we also were interested in the time varying part. And so I told you how we were going to calculate this time varying beta, which I put here. So the beta of this market could either be constant, or it could be some coefficient times this time varying one that I have just calculated from the Garch and DCC kind of thing. I do the same thing for the lagged one, and actually I've set it up so that these coefficients are known at time t-2, so that there's no correlation between those and the return model. And then this is estimated by what is effectively a least squares model, except that the error term is allowed to have a first order moving average, and it's also allowed to have time varying volatility itself. So when you do all that, you get a time series of the sum of these two coefficients, which is really effectively the beta we're talking about. And if you look at that for BNP Paribas, for example, over the sample period, you see it's pretty much hovering around 1.5. It's a beta a little bigger than 1. It went up a little bit in 2003. I'm not sure what the event is that produced that. But the main thing that's happened is, you see, during the sovereign debt crisis in Europe, the beta went up to sometimes 2.5, or maybe even as much as 3. And it moves around quite a lot. It's a lot of fluctuation in the beta here. It's now come back down again. So interestingly, the French banks seem not to have had a beta that increased very much during the financial crisis that I call our crisis, the subprime crisis that in 2007, 8, 9, although British banks did. So we do this recursively. Every week we update these estimates to get new betas, and then we use those betas to calculate what the market decline would be for each of these firms. And if you add it all up, all 1,200 financial firms around the world, it comes up with a total bill, which is what we think it would take to recapitalize all the financial institutions in the world if we have another financial crisis. So if the stock market goes down by 40%, global market goes down by 40%, how much capital is going to be needed? And the answer today seems to be about $2.8 trillion. Just a little under what the Chinese are presumably holding in their sovereign wealth fund. But of course, it's come down. It's come down since the Twin Peak crisis, the crisis in the U.S. crisis, when it was about 4 trillion, and then it was almost exactly the same in the sovereign debt crisis in 2011, 2012. So, yes, things look better, but they're a long way from before the financial crisis started. Where does this come from? If you look at the sum, this sum over all these firms, and you add them up by country, you see China is actually the biggest contributor today. The systemic risk in China is close to 600 billion. Japan is 525, something like that. So those two Asian countries are now on the top of the list. Didn't used to be that way. And France is the top European country. And since last spring, UK has moved into 4th position with United States in 5th. Then we have Germany, Italy, India, Canada, Netherlands, Switzerland, Spain, Brazil, Australia, Belgium, Sweden, Israel, Korea, Greece, and Russia. In Europe, we have a table like this, and we do for the US and each of these regions, which has for each bank what its systemic risk would be. So for Deutsche Bank, our number now is 75 billion, is what it would take to recapitalize Deutsche Bank in event of a financial crisis. Credit Agricole, 90. They were on top for quite a while. BNP is next, Barclays, SocGen, RBS, and so forth on down the list. London Stock Exchange. You know, stock exchanges now are suddenly appearing on our list. I have to think about whether that makes sense or not.
The market cap's nothing like that at the moment. London Stock Exchange Group, it's about a couple of billion.
Okay, so, well, I mean, you should tell me, but anyway, it looks to me like we're estimating a leverage of 93, so that so they must have a lot of liabilities, right?
I don't think they have that. It's a balance sheet artifact.
Okay, well, anyway, Bloomberg thinks they have liabilities that are way exceeding their market cap, practically 100 times their market cap. So there are, on every list, there will be some that we should discuss, and that's one we should discuss. But I'm just telling you, this is what you see if you don't make the adjustments. We did talk a little bit about adjustments for Credit Agricole. There's an adjustment we could make for Natixis, probably others as well.
So in the previous discussion, you said the leverage for Credit Agricole is 78,
Right.
and here it shows 30.
Yeah, so this is, the other discussion was, I don't know, 6 months or more ago. But I didn't redo those numbers. So Credit Agricole here, the leverage is 50 here, 51. So what across? So leverage is the last column, volatility is the one before, correlation, beta, MES, and S-risk are the columns here. And the first column is the percentage of S-risk that this firm is. So how do you know whether this is a good list? You know, we could wait for another financial crisis, see if these are the companies that get in trouble. We could say, you know, so another thing we might do is look back and see what these rankings look like at different points in time in the past. Since we estimate everything recursively, we're estimating every model using only past data. So, and that's what's on the website. So you can actually, let's see, if up on the top here, you can see there's a little box. This is the date. This is 9/19/2014, and a down arrow. So if you press this down arrow, you can go and look at what this table looked like any point in the past. Interesting exercise. So what do you see? So here's what the US looked like August 29th, 2008. This is what regulators were looking at before Lehman went under. And what you see is Citi and JP Morgan were on the top of the list, then Freddie and Fannie, AIG, Merrill Lynch, Morgan Stanley, Bank of America, Goldman Sachs, Lehman Brothers, Wachovia, Washington Mutual. This is a pretty good list of everybody that got into trouble. I gave you this list ahead of time so you recognize all these names. Every one of those, with the possible exception of JP Morgan, was rescued or failed. And interestingly, Lehman is not at the top of that list. Lehman, we don't think, was the most systemic. In fact, everybody above Lehman was rescued. Lehman was the highest ranked firm to be let go. And then Washington Mutual and Wachovia were, well, Wachovia was purchased, Washington Mutual failed, and then MetLife and Prudential and Hartford survived. So the insurance companies are pretty far down this list. Today they're up near the top of the list, which is an interesting thing by itself. So our view is that if you're going to draw the line somewhere, this wouldn't be a bad way to think about drawing the line as to who you're going to rescue and who you're not. If you look earlier, the question really is, did we have advanced warning that this crisis was coming? So let's look in January 2007. I personally think the crisis started in August 2007, so this is 6 months before it really started, but it's a year and a half before Lehman. And now if you look at the top firms, you've got Morgan Stanley, Freddie Mac, Fannie Mae, Merrill Lynch, Lehman Brothers, Bear Stearns, Goldman Sachs, MetLife, and Hartford as the top 10. So that's not very different in most respects. It has all the investment banks in there, including ones like Bear Stearns, which were no longer around, and they are argued to be the most systemically important at that point in time. The people not there are Citi, JP Morgan, the big commercial banks who were racing to get into the mortgage business. And they were falling head over heels to buy companies like Golden West and Countrywide that were in big trouble from the mortgage business, and they picked them up. They managed to get themselves to be systemic, and in 6 months or a year they were at the top of the table. If you look even earlier, you can see pretty much the same story. January of 2005, but without the commercial banks. So my feeling is that we had advance notice about a lot of the systemically risky agents, but some of them took on risk in the last days of the bull market that regulators wouldn't have been able to see in advance from these kinds of measures, but they could see that these transactions were happening and might really have stepped in and blocked them or discouraged them. So another way of trying to figure out whether there's any validity to this is to compare these estimates with what supervisors find when they look deep inside these banks, have a lot of supervisory data, and do the stress test. Stress tests have become a very famous and somewhat contentious topic. We now do them regularly in the US. Dodd-Frank mandated a once-a-year stress test. The ECB is taking over supervision in the Eurozone and has started the AQR, their asset quality review, which is sort of a pre-test, and then they're going to do regular stress tests as I understand it. But those were not the first ones that have been done. There have been stress tests that have been done in Europe over the last quite a few years, but they're done by national bank regulators rather than a Eurozone bank regulator. So supervisory stress tests have a lot more information because they're not just looking at market values, they're looking at all the bank books. It typically takes a year to do a stress test, and the the Fed puts people in these banks, and I think they have a whole floor of Citibank where the regulators sit to do these calculations and request information and evaluate the stress scenarios. The bank regulators formulate a stress. It doesn't have a probability with it, but it's some event that they're worried about. But they typically don't reveal this to the banks because they don't want them to influence their behavior. So each year there's this sort of secretive period working up to the stress test where you construct the scenario and then you tell the banks, and then you start the calculation of what is the effect of this stress on the bank. Regulators may use their own models, or they may use the bank's models. There's some discussion about that. Capital adequacy compares the ratio of whatever capital is left after the stress to whatever capital the regulators think should be had available, and capital shortfall is how much is going to be needed. So, I mean, there is a lot to say about the strengths and weaknesses of stress tests, which I'm just going to say a couple things. The scenario is both a strength and a weakness. If you get the wrong scenario, the stress test is worthless. If you get the right scenario, you're getting a measure of long-run risk, which is actually a very useful way of understanding the weaknesses of a bank. I already talked about the fact that it's got to be unpredictable what the stress is going to be, but that's kind of funny, because if we want something which is unpredictable, then what are the chances it's going to be the thing that actually happens that everybody is worried about? If it's unpredictable, it can't be that common. And one of the things that happens, of course, is that it's different every time. So time series doesn't really give you very much information about how strong, whether banks are improving or getting worse. One of the hidden features of these stress tests is that the capital estimate is the key part, and then it's usually divided by some measure of the size of the bank. But what you divide by makes a lot of difference. Typically, they divide by risk-weighted assets. So some assets count as a lot more than other assets in how big the bank is. As a consequence, there is no correlation between these assets. The use of risk weights wouldn't make any sense at all for a portfolio. It treats assets that are negatively correlated as just as risky one at a time as together. One of the fundamental theorems of risk management is that the risk of a portfolio is less than or equal to the sum of the risk of its parts. But this measure is just the risk of its parts. It doesn't have any covariance term in it. So I think that there's a big issue with risk-weighted assets, and we'll see that in a second. Okay, so we said, okay, let's look at these publicly available results from stress tests and take a look at what VLab was showing at the same time. Okay, so what do we like to know? We'd like to know whether we think the same firms are strong that the stress tests do. We'd like to know whether the risk weights predict risks that these firms face. And if something like the conjectured scenario occurs, do the weakest firms do the worst? So these are three kinds of measures that we want to look at for the stress tests. So here, for example, is analysis of the U.S. Capital adequacy test in 2012, 2013, and then the EBA in 2011. And the first row is the correlation. These are ranked correlations across all the firms that have been tested of the Tier 1 capital ratio using risk-weighted assets. And what you see is that VLAB and the CCAR are correlated with the coefficient 25%, which is about the same as for the EBA. That's, I guess, significant for the EBA because there are more banks, but not for the US. If you look at the Tier 1 capital relative to total leverage, the correlation goes up to about a half. And if you look at the highest correlation is when you look at the minimum over the cycle of the leverage ratio, of the Tier 1 capital leverage ratio. Then you get a correlation of 0.8 or almost maybe 0.9 across which firms you think are the strongest and which firms you think are the weakest. So that suggests that we're getting kind of the same story, especially when you divide by total assets rather than risk weights. Here are two plots which have on the bottom axis in 2014 the CCAR capital ratio and the VLAB capital ratio. And as you see, they're spread out. Not a bad correlation between them. A lot of the weakest banks are in common down here, and the strongest banks are sort of spread out a lot. In fact, we have American Express up here, which is a big outlier. We think that's very safe. So does CCAR. They think that it has capital of 11%. We think it's 25%, but those are all big positive numbers. So it doesn't actually fall right on the line here. We have a little bit of difference, some of the weaknesses. The weakest bank by the CCAR was Zions Bank, whereas we think the weakest one was actually Morgan Stanley. But, you know, it's kind of a group here. When you look at the let's see. So here is, I guess, with the leverage ratio. This was with risk-weighted assets, and you get a correlation of 0.7 rather than 0.3. So this is a much tighter kind of a fit. And actually, Morgan Stanley is pretty much the bottom in both measures there. If you look at this is in 2009, and it's kind of the same. So, oh wait a minute. No, this is looking at risk weights. Do the risk weights in the used by the regulators match the risk weights implicit in the VLAB? Because we basically have a single measure of risk for the firm as a whole rather than risk-weighted assets for individual assets. So you can plot VLAB risk weights on the vertical axis and SCAP risk weights on the horizontal axis, and there is a positive slope, but it's not very impressive. They're pretty unrelated. If you look at the same thing for the EBA, you get a negative slope. The firms that we think are the more risky, they think are the safest. And if you look at this is a maligned stress test. I agree, and this example makes that clear. If you look at the correlation between the stressed capital ratios, you see again we're talking about basically pretty high correlations when you divide by total leverage, but not nearly so high when you divide by risk-weighted assets. So we're talking about like 70%, I think. Here's the worst thing, which is how much capital did the EBA think these firms needed? The answer was they're all okay. Nobody needs any capital. Here's zero. They're all piled up on zero here. No capital needed. The only people that needed capital were two Greek banks and an Austrian bank. Okay. Well, you know, history was not very kind to this answer because it was only a little bit after that that Dexia went bankrupt and a variety, several other banks got into trouble. So there are a lot of other things in this paper, but basically you can look at at how well these rankings predict future outcomes. And when you do that in Europe, the EBA ranking was terrible in predicting which banks were going to do badly and which ones were going to do well. In fact, it's a negative correlation between how they actually did in the subsequent downturn that we saw in Europe. So I think we're actually, there's a reasonable argument that this market data which is publicly available, does at least as well as most of the stress tests, and at minimum it makes sense to combine these kinds of approaches and look at both measures. I don't think there's any reason not to do supervisory stress tests, but I think there's a good reason to try to do them better. And so the idea of combining publicly available information with supervisory information makes a lot of sense. Okay, so let me just say a few more things here. If you were going to regulate based on S risk, you'd probably have a criterion like they shouldn't need capital in a financial crisis. But the problem with that is it's a very pro-cyclical measure. It says that a bank that gets into trouble is going to have high S risk, and they're going to be told, okay, now that you're in trouble, raise capital. Well, that's hard to do. So regulators are faced with the problem of how do you convert what is a very pro-cyclical kind of regulatory environment into something which is counter-cyclical. And there are several challenges in doing that. One is that we only do one stress test a year and it takes a whole year to do it. How far ahead do you have to predict in order to do this thing? It seems to me if you're going to be counter-cyclical about this, you're going to have to do something faster than that. Can't respond to the stress test and then give banks a year to respond to your new capital ratio and then wait. So I think we do something like this with our income taxes. If you earn income over the year, you have to estimate how much it is. And if your estimates are too high, you get a rebate at the end of the year. If they're too low, you get a little penalty, and then you've got to pay at the end of the year. You could do that with stress tests. You could use market values, the data, on an ongoing basis to say, by the end of the year, when we do the stress test, you've got to come up to this level. And if you don't, there's a fee. So we're hoping that we'll be able to come up with something like a Taylor rule for capital ratios. You'd like to be able to raise capital ratios in good times and then relax them in bad times. The question of whether you want to relax them below 8% or not is kind of tough. I don't know whether you can count on economic analysis to answer that question, but a lot of regulators think you should never. There's one thing to have advanced provisioning, but it's a different thing to actually lower the requirements when we're headed into a recession. We also have another measure which I think might be even more useful of the capital that a firm would need. It's what we call precautionary capital, and it's got more of a risk-based notion. We think of this as a risk-based total leverage capital requirement, which would be to say that how much capital would the firm need so that the probability of the leverage exceeding some value in a crisis is less than some number. So if you want a 5%, it's like a VAR measure, or it could be done like expected shortfall. If you don't want the leverage to fall that low, then you would require a lot of capital ahead of time. There are issues in how you would actually calculate this, because if you put in capital ahead of time, this is going to reduce the leverage, and in our current model that wouldn't change the volatility, but we need a model which we call structural Garch model, which actually takes leverage into account in predicting volatility, and I think we have that model, and that's the way we're going to do this. So quickly, let me just show you some pictures of what we're seeing today. This is what's happening in the U.S. You see a big improvement in the S risk in the U.S. It's down to 300 billion from more or less $1 trillion in the worst of the financial crisis. When we look at the countries, it might be we should look at S risk relative to GDP. If we do that, France is on top, UK is second, Japan and China have moved down the list a little bit. So it may be that France and UK are the most exposed. If you look at Europe since 2004, we have another 6 months from what I showed you yesterday. It's been pretty flat for the last 6 months. It doesn't, the S risk has not been continuing to decline. If you look at the UK by itself, you see it's actually come down quite a bit since the sovereign debt crisis, but is still well above the pre-crisis levels. What companies are highest on the British list? Well, we've got Barclays and RBS, and then the London Stock Exchange, which we could talk more about, and so forth on down here. But the biggest is Barclays. The event that we're particularly focused on now is Asia, since S risk in Asia has been increasing, while in Europe and particularly in the Americas it's been decreasing. So where is that coming from? Well, here's China. China is just the risks of the undercapitalization of its banks is increasing very rapidly. And you probably noticed in the paper last week, they just, the PBOC just injected $81 billion into the Chinese banking system, which I suppose will show up here. 81 billion is, you know, that's 100 billion between 600 and 500. So, you know, that might move it down. What's that? A few inches. But there's a lot to go. And there are a whole lot of issues about China, which might come out in the discussion. I mean, since these are all state-owned enterprises, they're clearly going to be bailed out if necessary, but of course they're also too big to fail in the ultimate sense of the word. So it's quite an issue as to what's going to happen there. And the Chinese are very aware of this. They're very concerned. They're working on lots of different angles as to what to do about this, and they're actually reaching out for advice, and people are advising them a lot of different things. So what's going to happen? I don't know. But that's the end of my talk, except that I have a concluding slide, which is probably for the whole week.
From the makers of RageX comes Contagion X. If you think you've been exposed to contagious sovereign infection, Contagion X is for you. Sovereign transmitted debts don't have to be embarrassing or keep you from other financial relationships. You can stay on top by protecting yourself with Contagion X. Rest easy, even if you've engaged in risky foreign exchange swaps or been with numerous indebted foreign partners. Contagion X works by releasing a powerful dose of austerity on troublesome workers, reducing your risk of financial infection so your wealth can be preserved. Ask your central banker if Contagion X is right for you. Contagion X is most effective when used 100% of the time on the other 99%. In certain cases, Contagion X has resulted in riots, defaults, fallen governments, and civil unrest. Unemployment, recession, and economic impotence are likely to occur with the use of Contagion X. In German clinical trials, some bankers have experienced delusions and hallucinations, and in some extreme cases, Contagion X may destroy the very monetary union it is attempting to save. If you're a Wall Street bank exposed to European banks who are exposed to infected nations who are exposed to Wall Street banks, Contagion X is for you. Contagion X. Just because it's your fault doesn't mean others can't suffer for you.
That's good? So, good.
He's eaten a bit into his own question time, so fire away, Tom.
Yeah.
Can you say a bit about central counterparties and clearinghouses, because the reason London Stock Exchange Group is so high on your list is it's true they've got $480 billion of liabilities because they're in a central clearing house. They've also got exactly $480 billion of matched assets, and they've got collateral. And a lot of people are pushing for central clearing in order to make the system safer. But on your measure, it would make it appear more dangerous.
Right, because they have no capital.
Yeah, they just take collateral
No
and they
equity.
match the assets and liabilities.
Well, my feeling about central counterparties is that it does make the system safer as long as you recognize that these are effectively public utilities, and there should be no question about whether they would be rescued if they really get into trouble. Now, that doesn't solve the management problem. You still have to have a regulatory supervision of them. But so, I mean, I think you're right that maybe they don't need to have so much capital. On the other hand, they are a publicly traded company. The value of their stock goes up and down depending on the economic health of the exchange, and you know, it's a little bit like Freddie and Fannie. We didn't know whether they were public or private, and you know, that confuses the stock market, and it confuses the regulators, and it potentially confuses this, although it's not totally clear what we should say. I mean, maybe we should throw them out entirely, but I'm open to opinions on that. We have this the Swiss National Bank in here, because the Swiss National Bank actually has leverage of about 1,000. They have equity, a little bit of equity, and lots of liabilities because of their quantitative easing, and so they look extremely systemic. But I was convinced that we should drop them, and maybe the London Stock Exchange should be in that category too. Yes.
I have a question which is somewhat related to this question, but this regards the U.S. When you did you compared CCAR with S-Risk, you know, there was one outlier that you didn't talk about, which is BONY. And BONY also plays a role of has a central role, because BONY is the custodian for a lot of assets, just like, you know, it has a predominant role as being having some sort of systemic importance, even though I think it's well capitalized. But CCAR really puts it at very, very high risk, and you put it at a very, very low risk.
Right.
Maybe it's also because of you're looking just at the equity.
I think it's the same reason. I think that the regulators have declared BONY systemic for exactly this reason, and require higher capital for it. By our measures, it's well capitalized, but we don't take account of its unique role in the financial sector, which might say it should have even higher capital requirements than another institution. So that's a place where I think we deviate from regulators, and probably the regulators have a good. I think they have a good reason for it. Let me tell you another place where we deviate from the regulators, which is large but very safe banks. For example, Standard Chartered. I don't know whether you noticed when I showed the UK. Standard Chartered is way down the list, but they are considered to be systemic by Basel. Why is that? Well, I've actually talked to them about that. I said, are you upset at this? And they said, no, because we are very safe, but we're very big. And because we're so big, if we change our policies to take on too much risk, they want to be there.
You know, Standard Chartered is a note issuing bank in Hong Kong. It's a very systemic bank in Hong Kong. So perhaps if you look at the entire global activity of Standard Chartered,
Well,
Can I add that? I didn't see HSBC anywhere there, and it's even bigger.
HSBC, I think, yes,
Didn't appear in any of your lists.
it's HSBC is probably has a capital surplus,
Yeah.
and so it's on the other end of the list. In other words, our S risk starts from the most systemically risky, and then it goes down to the least, which are the ones where they have more than 8% capital during the crisis. And HSBC is an example of an overcapitalized bank. Wells Fargo is an example of an overcapitalized bank. Are these systemic because they're big? That's, yeah.
So in the definition of S-risk, unlike the regulatory stress test, you give a very important role to equity because you define the risk
Right.
scenario as a
Right.
40 or 50% drop in the
Right.
equity index. In regulatory stress tests, they usually define the stress in terms of other variables,
Right.
which can be credit related to credit, loans, things that might not show up in market data because
Right.
they're completely illiquid. So maybe is that the reason why there is a discrepancy in a lot of these things, or and
Well-
how could you adjust for this? Because you have some banks where they have a lot of activity in illiquid loans and
Mhm.
so on. That might not show up necessarily in your type of assessment.
Right, so this is clearly a one-factor model, whereas stress tests are multi-factor models. They stress a variety of different risk factors, not just one. So why is equity a reasonable thing to stress? Well, if the global economy goes down, global equity markets go down. Now that doesn't depend on what was the cause, but the cause appears in this model in a subtle sort of way, because if your bank is holding assets which are insensitive to the global economy, then you wouldn't expect to see much decline in its asset value, so you're going to get a low beta. If you're holding the assets which are highly correlated with the global economy, as an investor, you're going to shed those shares exactly when it looks like the global economy is going to be in trouble. So you'll get a high beta. And what you see is that the betas went up a lot for these firms that were doing all the all the mortgage securities during the financial crisis. And what really we think, I mean, I'm drawing so when the stock price of Bank of America goes down, is that just people's speculation about the future of Bank of America, or is that a reflection of the fact that the assets that Bank of America holds have gone down in value? And so we like to think that that's what we're actually measuring, is that the asset values go down even though they're not traded. We don't see those individual prices, but investors do. And one of the things that we see in China, of course, is that the equity values of these banks have gone down, even though their assets apparently haven't gone down. Why is that? Well, because the assets are loans to state-owned enterprises that are non-performing and to municipal governments that are non-performing. So the equity value decline is a reflection of the asset value decline, the way we see it. And so we think we have, at least arguably, from the one-factor model, the same kinds of implications you'd have from a multi-factor model.
Very short question. Torben is next.
Okay, so I wondered if you could talk a little bit about the
No, you
difference
can't.
between the size of S-risk and then the probability that you get in trouble first, maybe. And so S-risk is very important for understanding the potential funds it takes to get this out, but you yourself mentioned the issue. As things get worse, you need to start asking them to raise capital. There you really want to focus on the institutions that might get in trouble, and that's not just a function of size, obviously.
Right. This is what we're working on, actually, is how does a high S risk translate into a financial crisis? If S risk is high for a firm, we think they were going to deleverage, but there are a lot of ways to deleverage, so we've got a sort of a firm-specific model of deleveraging, which is a response to high S risk. That deleveraging then feeds into the macro economy because it's going to be a reduction in loans, among other things, and some asset sales. And those loan reductions would then trigger macro events including a further fall in the stock market, and you see this kind of thing. It's a complicated process to get right, especially to get the timing sensible so that you could figure out how you want to do countercyclical policy. And I think that is, that's a challenge. We're delighted if anyone has ideas, to add to what we're thinking about on how to do this.
Robert, I have a question. Isn't there an issue in this whole business of public systemic risk monitoring that, the NYU is a highly prestigious institution and the people behind it have a very high reputation and very respected in the community, and you could be an unintended expectation coordination device just by everybody looking at the measure, coordinating the expectations in a way you wouldn't want to do that.
People ask me, what is the implication of this for investment portfolios? And my first answer is, this is not predicting what's going to happen. This is reflecting what you already think is going to happen. In other words, because it's based on the stock market prices, it's just translating those into something else.
People don't see it that way. When Paul Krugman went public and said Austria is the next country to fall after Greece, it was like a self-fulfilling prophecy. It didn't happen.
I don't think people take us that seriously either. But but I think that that when investors think about, do they want to be holding bank stocks or not, they might look at this list, but they could come up with different ideas. They could say, I don't want to hold these systemically important banks because they're going to be in trouble, and so they might short them. But other people might look at this list and say, they're going to be bailed out, so I think this is actually where the opportunity is. And so I think that what we see in the stock market is a blend of those two points of view, and that's what gives us the numbers.
Last question.
This whole story applies to publicly traded
Right.
institutions, but there are quite some
Right.
really big not publicly traded. For example, in the Netherlands, there is this big pension fund which is gigantic, and it's not publicly, and yet we would like it to be on the list. So how would you include those?
You want to be on the list, okay?
No, I don't want them. I want them to be
You
on the
want
list.
them to be on the list.
That's where my pension is.
There are lots of non-traded financial firms, and I really don't see how we can put them on the list. One answer is to say they're really just the same as the publicly traded firms, and so we're going to multiply them by 3. Or whatever the total liabilities are, and so that makes the number bigger. But that doesn't answer the question of how they're managed, nor whether they're, how much risk they're taking, or any of those kinds of things. So I don't, if you're a regulator, you have to answer this question. If you're an academic, you really don't, actually. I don't think anyway.
I'm going to abuse my role as chairman just before finishing the session to tell the story I nearly told at the beginning. On the morning that Lehman's went bankrupt, as Rob will remember, he was in my kitchen having breakfast with me. And I said, this is like Kreditanstalt, the Great Depression is back. And Rob said, it's only an investment bank, it doesn't matter. Thank you, Rob.
Did I say that?